Today, we will talk about accounting principles explained, how they work, GAAP, IFRS. Accounting principles are the rules and guidelines that companies and other bodies must follow when reporting financial data. These rules make it easier to examine financial data by standardizing the terms and methods that accountants must use. The International Financial Reporting Standards is the most widely used set of accounting principles, with adoption in 167 jurisdictions. The United States uses a separate set of accounting principles, known as Generally Accepted Accounting Principles, GAAP. The ultimate goal of any set of accounting principles is to ensure that a company's financial statements are complete, consistent, and comparable. This makes it easier for investors to analyze and extract useful information from the company's financial statements, including trend data over a period of time. It also facilitates the comparison of financial information across different companies. Accounting principles also help mitigate accounting fraud by increasing transparency and allowing red flags to be identified. Comparability is the ability for financial statement users to review multiple companies' financials side by side with the guarantee that accounting principles have been followed to the same set of standards. Accounting information is not absolute or concrete, and standards are developed to minimize the negative effects of inconsistent data. Without these rules, comparing financial statements among companies would be extremely difficult, even within the same industry. Inconsistencies and errors also would be harder to spot. The most fundamental accounting principles include the revenue recognition principle, matching principle, materiality principle, and consistency principle. Completeness is ensured by the materiality principle, as all material transactions should be accounted for in the financial statements. Consistency refers to a company's use of accounting principles over time. Generally accepted accounting principles are uniform accounting principles for private companies and nonprofits in the U.S. These principles are largely set by the Financial Accounting Standards Board, FASB, an independent nonprofit organization whose members are chosen by the Financial Accounting Foundation. A similar organization, the Governmental Accounting Standards Board, GASB, is responsible for setting the GAAP standards for local and state governments. And a third body, the Federal Accounting Standards Advisory Board, FASB, publishes the accounting principles for federal agencies. Although privately held companies are not required to abide by GAAP, publicly traded companies must file GAAP-compliant financial statements to be listed on a stock exchange. The International Accounting Standards Board issues International Financial Reporting Standards, IFRS. These standards are used in more than 120 countries, including those in the European Union, EU. The Securities and Exchange Commission, SEC, has expressed interest in transitioning to IFRS. However, because of the differences between the two standards, the US is unlikely to switch in the foreseeable future. The FASB and the IASB continue to work together to issue similar regulations on certain topics as accounting issues arise. In the United States, generally accepted accounting principles are regulated by the Financial Accounting Standards Board, FASB. In Europe and elsewhere, International Financial Reporting Standards, IFRS, are established by the International Accounting Standards Board, IASB. IFRS is a standards-based approach that is used internationally, while GAAP is a rules-based system used primarily in the US. IFRS is seen as a more dynamic platform that is regularly being revised in response to an ever-changing financial environment, while GAAP is more static. Critics of principles-based accounting systems say they can give companies far too much freedom and do not prescribe transparency. They believe because companies do not have to follow specific rules that have been set out, their reporting may provide an inaccurate picture of their financial health. In the case of rules-based methods like GAAP, complex rules can cause unnecessary complications in the preparation of financial statements. Accounting principles are rules and guidelines that companies must abide by when reporting financial data. Whether it's GAAP in the US or IFRS elsewhere, The overarching goal of these principles is to boost transparency and basically make it easier for investors to compare the financial statements of different companies. Without these rules and standards, publicly traded companies would likely present their financial information in a way that inflates their numbers and makes their trading performance look better than it actually was. Here are 5 key takeaways. 1. Accounting standards are implemented to improve the quality of financial information reported by companies. 2. In the United States, the Financial Accounting Standards Board, FASB, issues generally accepted accounting principles, GAAP. 3. GAAP is required for all publicly traded companies in the U.S., it is also routinely implemented by non-publicly traded companies as well. 4. Internationally, the International Accounting Standards Board, IASB, issues International Financial Reporting Standards, IFRS. 5. The FASB and the IASB sometimes work together to issue joint standards on hot topic issues, but there is no intention for the U.S. to switch to IFRS in the foreseeable future. Hope this would help. Thanks for watching.